most people call me Andy Egwim. It's NWC Andy Egwim. The founder of Moneywise Doctor.com. So it's a platform that helps doctors and healthcare professionals make smarter financial decisions. You might see a lot of our video contents. We've got 60 to 100 blog contents, about 300 videos now. It all deals with stuff that mainstream finance and media might not cover that affect doctors and healthcare professionals. I happen to be an IMG doctor, so I was originally born in Nigeria. I moved here to UK 2015 to do my master's, but before then I'd already been investing since my late teens, actually, if 19 still qualifies as teenage, and that actually put me in a position to leave my salary job 2 years ago. A lot of things I did were nothing special. A lot of them are things you could do. Sometimes all you need is just to have the right information at the right time, have the direction. I'll give you a quick example before we launched into question and answer. You're 36 or you're 35, you come into the UK, you didn't know about the lifetime ISA. You didn't know that you could actually save money to buy your first house and get an extra £1,000 per annum from the government to add to your savings. You find out when you've turned 40, 41. By then it's too late. You've lost that opportunity. You can't really access it again. So the difference between knowing and not knowing can be quite expensive. In my own case, I found out about lifetime ISAs. When I started using them, there were no lifetime ISAs. I found out about them totally by mistake. I went to the bank to do some, open a second account. I was a master's student thinking, well, I'm leaving after my master's anyway to go back to Nigeria. I had a business in Nigeria and I was working in an NGO. And I thought, you know what, let me have 2 accounts just in case when I live in the UK, when I leave the UK, I have an extra account to do my transactions. Then the clerk at the bank said, have you heard about the ISA? Do you have an ISA? Then I went to start researching this stuff. At first, I couldn't believe it. The government is really going to give me some money to save my own money. That in those days, you could actually get 25% of what you save, and the maximum you could save was £200 per month. So the maximum in a year is 2,400. So what you could get is 600, the maximum bonus per year. So that's basically 200 times 12, 2,400. Let's not do public math, but I think that should be 2,400. So the maximum the government could give you is 600 before they introduced lifetime ISA. Now, if I tell you the number of people who said, how come I never knew about this? I've been in the UK for 5 years, 6 years, 7 years, and now I'm beyond 40. I can't open that. If I actually got like just £1 every time people said that, that would be more than enough to replace this shirt when my toddler eventually stains it this evening. Okay, so basically, knowing and not knowing can be expensive. This is just one example. Obviously, there are other examples, like we talked about claiming money back. They've had doctors who stayed in the UK 7 years, 8 years, lost out a whole 5 years. So you can't go back more than 5 years. Actually, you can go back 4 years. From the year you are, go back 4 years to claim. So these are just not knowing. Or for instance, my personal mistake, I've always been investing. So jump into the UK, start investing, didn't know about the stock and shares ISA at first, made good profits in my investment, was very fortunate, followed usual fundamental investing principles that we taught in the masterclass. For those of you that joined me in that 4 weeks investment masterclass, and I made good profits, was returning about 50-60%, but then realized there was stock and shares ISA, which meant that I didn't have to pay profit. I didn't have to pay tax on any of those profits, but I had mistakenly opened that account as a general investment account. So it was too late. I had to sell at some point. I had to wait. Even you're making profit, but you're annoyed. If I had known, I should have made that mistake. That's why going forward, I'll say before you make any investment, use your ISA first, maximize your ISA. And there are many other things. I know I've had people say, wow, is that really true? Can I use my limited company to buy an electric car? Of course, if you're using it for your business, okay, knowing about benefit in kind, and it's all tax-free. Or can I use my limited company to pay into my pension up to £60,000 in a year, or pay into my life insurance? It's called relevant. There are like 100, 200, 300 things that we keep finding out. We keep sharing them. And whenever I have my one-on-one sessions, it will play a little game where I think it's going to take at least, I count the number of minutes it's going to be before someone tells me that they've never heard about something that I've made like 30 videos about. It never takes more than 5 to 10 minutes before the person says, I'm really sorry. I've never heard about ISA or that you can do this. I'm like, okay, it's fine. Because at the end of the day, we all get our own information at different times. And what's important is that when you get it, you act on it. Right. So now that I've made that rather long introduction, I'm going to hand over to Chigo and say to coordinate if anyone has any further questions or anything you want to ask, to please let's crack on for the evening, because I want to make sure that it's worth your while if you've taken the weekend to share it with me.
We have some questions already on the chat.
Okay.
Femi, do you want me to read out or do you want to ask directly?
Yeah, you can ask directly.
Yeah. Femi.
Okay.
Femi.
Yeah, thank you for this opportunity.
You're welcome.
When I just came to the UK just last month, but I've been following your videos. I've read about ISA and the cash ISA and the LISA, and I've also started. But on my skilled worker visa, I noticed that I cannot do any other thing apart from working in the hospital. And I'm someone that likes investing in crypto and Forex. So I want to ask, will I be penalized if I still continue to do these things? And will my income be taxed?
That's a very, very, very valid question. Basically, you're tier 2. So you're on tier 2. I used to be on tier 2. It relates mainly to your work, basically. So on tier 2, you can, I'm not a legal expert, okay? But just from my experience, I'm working with lawyers as well. On your tier 2, it allows you to do any work that you've been given the visa for. And you can also do a similar work as long as it's no more than 20 hours. Investing, just like I'm an investor in a number of companies, and next week I've been invited to invest in a new startup. I'm going to have a meeting with them to see if it's worth it, but I don't work in that startup, so it cannot be counted as working. So if you invest in crypto or stocks or Forex or whatever property, that is not work for you, so that is investing. So I don't think it should be an issue. This is my understanding. Of course, you're welcome to check it out with an immigration lawyer if you want to have 100% certainty. In my own experience, when I was on tier 2, I had a business. I had Holistic Dimension Limited. I had Planner. And I also had a baby bump package. So the e-commerce online, I was investing all the time. I had a limited company. So it was never an issue when I got my ILR and citizenship. So I don't think that should be an issue. Now, regarding tax, of course, you're going to be taxed. If you make money, you're going to be taxed. If you make any money that is outside an ISA, you owe the UK government some. If you make it in the stock market and you haven't invested it through an ISA, then absolutely you do need to pay what we call capital gains tax. So if you make a profit on property or stocks, or even if you just went to buy like a pair of rare sneakers and make some money, you need to declare it now if it's over £1,000. So yes, you're going to be taxed. You need to declare the tax. That's why we suggest that if you have multiple sources of income, you should do a self-assessment and declare if you've had some extra income. The funny thing is, my experience after the self-assessment, sometimes the government owes me money. So if you do the self-assessment correctly, sometimes you'll be able to claim back some other things as well. So that could be something to think about. But again, it all depends on what you're investing in. If you make a loss, it's not taxed. But if you make a profit, it's taxed. I want to believe that obviously you understand what you're investing in. I hope that answered the question. And if that helps, give us a thumbs up and we can jump into the next one.
Yes, thank you.
Lovely, thank you. Can I just thank again? I'm going to thank Chigo and Odekunle and everyone else who is courageous to have their cameras on, so that they make me feel less lonely and it doesn't feel like, oh, it's just me here talking to myself and the camera. If you don't mind, if you put your cameras on, but I understand it's a Saturday, so if you don't feel like it, or you've had a couple of bottles, or you have your little one sitting in your laps, whatever. But if you're able to put on your camera, I really appreciate it, and it helps with the connection. All right, who's next?
Next we have Odekunle. Should I read out, or do you want to ask directly?
Yeah, I can ask. Thank you very much.
Sure.
I've actually penned down a number of questions. I hope it's okay.
Of course, why not?
Okay, so the first question was, I've never done self-assessment. It seems like something that is quite daunting. And I was thinking in terms of diversifying income streams. So, for example, books or other sources, real estate, or whatever. So, I'm thinking in terms of avoiding doing this self-assessment. Is it possible to just let everything go through my limited company? Is that wise at all? That's the first question.
That is an excellent question. Chigo, if you don't mind, if you find my article on doctors, that's is ranking. I think it's ranking number 1 or something. Did we check it recently? I think it's now on the front page. Okay. It's usually
Yeah.
nice when people can find the article and you're ranking number 1 out of all the financial firms and banks. But this is a really important question, Femi. I don't think there's a lot of material out there answering it. You want to do other side hustles, you want to get other additional income, but you're wondering the best way to report your taxes, right? So I've done a detailed article. Chigo, if you get it, post it in the chat box so everyone can get it. On just type self-assessment, Moneywise Doctor. So there's a number of people that need to do self-assessment. It's not even an option for you. Okay, I found it. So it's not an option for you as a doctor if you meet a number of criteria. Okay, one, if you are self-employed, for instance, if you're like me, if you haven't got a salary job or you're self-employed or you have a business, then you need to do a self-assessment tax return. If you have business partnerships, maybe you've invested in a partnership or you're part of a partnership, then you definitely need to do a self-assessment, okay? If you have capital gains, like you've invested in property or stocks and bonds or any other thing that gives you capital gains. So for those of us who haven't looked at my investment videos or you weren't fortunate to be in the investment masterclass, the 4 weeks masterclass, capital gains, basically, if you don't already know, is basically if you buy something and it increases in the value, appreciation in value, the difference between what you bought it for and what the next value is capital gains. And the government wants a bit of that. It's 28%. Well, maybe 24% now. They reduced it, depending on whether it's property. So I just wanted to give a bit of a general idea so other people who have other questions along those lines can have it answered at the same time. Now, if you meet all these criteria, or let's say you have a high income benefit charge, maybe you or your partner is earning above £50,000, then you absolutely have to do a self-assessment. Now, to answer your question, you could use a limited company to do the you could use a limited company to deal with your stuff. For instance, if you have a property company, if you deal in property, you can use what we call an SPV. So a special purpose vehicle can help you do all your transactions through that limited company. But that limited company is a different entity. That's not you. Okay. If you are, let's say you are a GP and you are lucky to be able to work outside IRO 35, that means that you can work independently and your employer pays you through the limited company, or you're a psychiatrist or whatever you do. So that limited company has to report taxes on their own. That is not you. Self-assessment is you. So even if you use a limited company, at the end of the day, you still have to do your self-assessment. So all my companies, I report and file taxes on them, not me, because I don't have the time. My accountants do. I report and file taxes on them. And then I also do a self-assessment for myself. Does that make sense?
Yes, yes.
It doesn't seem like that fully answers your question. Does that fully answer your question on that particular issue?
At least I have a better understanding of it. I'm looking forward to the link to the,
No. So you have a better understanding. The link will be shared in the chat.
On the chat. Yeah.
It's on the chat.
Thank
I'll
you.
probably also email it out in tomorrow's newsletter for those of you, if I remember. Hopefully I remember. I'll add it to tomorrow's newsletter. Look at the scenario like this. If you're a doctor, like a GP, you're working as a salaried doctor, and then you get a locum job that agrees to pay you into a limited company. What's your job? What's your role?
It's a hybrid role, salaried and...
Is it GP?
Yes.
Okay,
so
good.
That's exactly my situation. I'm a salaried GP and I do locums as well. Locum pays into the limited company. So
that is a situation I've been into. So I've been in that situation in the past. So your salaried work, obviously, salaried income, is already taxed, PAYE. Your locum comes into the limited company. So limited company obviously gives you a lot more flexibility to do things, including the expenses. You can hire people, you can do all sorts of stuff to your limited company. You can pay into your pension without having to go and claim it back. But because you have a limited company, you must do self-assessment. If you don't do it, you do it later. If you don't do it, HMRC can write you a letter out of the blues, just like 4 years later. Let me tell you something. Every year I get a letter from HMRC. Every year we exchange love letters. They write to me, they'll say I'm owing them. I'll write back to them and say, no, we eventually balance things out. So it's always better to be proactive when it comes to taxes. Nobody wants to mess with HMRC. So you are eligible to do self-assessment. Whether you do it now or not, no problem, because what has happened to me in the past, I've been written by HMRC to do self-assessment. This was even before I became a GP. For something, they said, okay, there was one charge that came up and I had to do 3 years in a row. So since then, I just do it every year. You can do it by yourself. And on Tuesday, HMRC did put on a seminar, which I enrolled to attend, but was just busy and I didn't get to go. Well, I was sleeping. But HMRC put on a seminar on Tuesday for self-assessment. So they have such seminars. It's free. You can attend it and you can see the step-by-step. I prefer to have an accountant on my side. So if I pay an accountant, a specialist accountant, they know what they're doing. I use the Moneywise Doctor approved accountants, but you can use any accountant that you're happy with. They file your self-assessment. They take that pressure off you. But you also need to file your limited company because it's a different entity from you. Okay. All right. Okay. Well, what was the other question, Kule?
Yes. So I think you've delved into some of the questions actually.
That's brilliant.
The next was, how can I utilize the money made in my company? It feels like I'm working, but I don't have access to those funds at the same time.
Let's see, Chiga. Okay, so sorry, I found it. I was going to ask you to find another article again. So another great article, I think that's the most visited article on our website. Limited company for doctors and healthcare professionals. I don't know. I've got like lots of nurses and doctors, particularly. I don't know if it's nurses mainly that are visiting that article. So I've posted it in the chat.
If you're wondering if a limited company is right for you as a doctor or physiotherapist or healthcare professional, maybe a medic doing some locums or have some side gigs, a limited company could save you thousands, but it's not for everyone. Now, my free guide explains, based on my own experience and from research, when to consider a limited company, the pros and the cons, how it works for doctors and healthcare professionals, and you can get it all for free. So get your free guide with the link in the description. Now let's jump right back to the episode.
Part of why we say the mastermind, basically, most people find out that in the mastermind, within their first 2 to 3 months, the investment or whatever they paid, or sometimes within the first couple of days, whatever they paid to join the mastermind, they get it back like ×5 or ×6, just because you get some nuggets that drop and you think, oh, is that what I was doing? Example is limited company, right? With your limited company, it's a big question. You make money inside it. You've been paid inside it. You need the money, but you are over here. You're Dr. Aro Safe. This is you. Then your company, let's say Dr. Kunle Limited, is here. You are two separate people. How do you take some of the money from here and get on this side? So that's why I've done that article. I'll tell you some of the commonest things people could do. One, obviously, you have expenses. You're a director of company, whether you are employed anyone or you're not employing anyone, you're director of a company, you're an officer of the company, you have expenses. Those expenses could be joining a course or training to help you to learn how to better run your company, because we've had people who join courses and they're able to pay from their company because they needed to, you've not had any formal business training. So joining a course where you were trained by doctors or accountants or something to help you to manage your company's finances and also make sure you're not messing up your company records. You could actually charge for that and deduct it from your expenses. Let's say you work overnight, you're allowed to actually spend some money overnight. I don't remember the exact amount, but you can actually deduct the money you spent where you work overnight. But there are many other things, like with a limited company, you could buy an electric car, it hasn't been changed. 100% if it's 100% electric, it's actually tax deductible. It's an expense that you can deduct. Again, I'll just sound it, that car must be used for your business. If you use it for anything other than your business, obviously your business is locum. If it's locum, you do. If you use it for anything other than your business, you're supposed to declare it in what we call benefit in kind, which is in self-assessment, and then pay back some of the money. But there are many other things. One is life insurance is a big one. We say everybody needs life insurance, especially if you've got dependents. If you've got like anyone who depends on you for income, then you do absolutely need life insurance cover, so that if for any reason you're not here, then definitely they are provided for. And I became more hot on life insurance since last year, when unfortunately I lost my colleague who was a childhood friend. Well, I don't know, wearing children then, we're like about maybe what age do you get into med school? Maybe like 18. But sadly he died in London. Excellent surgeon. So since then I've thought, well, it's really important to have life insurance.
Now, this is a very crucial topic. Have you secured your family's financial future? Many times you're busy as doctors and healthcare professionals. That's fine, but if we overlook our life insurance and income protection until it's too late, we're taking a bit of a risk here. I mean, nobody can predict the future. You need to protect what matters most. Think about life insurance and income protection. This is really quite important to protect your most valuable assets. Now, if you're not sure about what you need or how to go about it, check the link in the description. I have a free guide that can help you step by step. Let's get back to the episode.
Now, if you have life insurance and you work through a limited company, you can ask your insurance agent, if they are good and they know what they're doing, they can do something for you called relevant life plan. So a relevant life plan is a life insurance for limited company director. Again, this is all available. Chigo, if you can manage to find our guide, is on the homepage, life insurance for doctors and nurses on Moneywise Doctor. If you find it, again, those resources are available totally for free. You can download them. It tells that if you've got a relevant life plan, that means it's just a fancy name for a limited company director life insurance. So you can definitely pay money from your limited company into your life insurance, which I have done for years, and it's counted as an expense. That money that would have come from your pocket, you ended up basically, getting it from your limited company to pay. Okay, now let's get to heavier things. We've already talked about cars, whether it's a 40,000, 50,000, 60,000 pounds car. I had a doctor consultant join me on a one-to-one session. Those sessions are paid sessions, and some of you don't need them, but those that need them, I actually beat down my door for them. I think we've got like 14 people now on the waiting list. But this doctor had recently bought a Mercedes, nice, lovely electric Mercedes, for about 50-something thousand pounds with her own money. She had limited company. She didn't know that she could actually buy this through a limited company. And this was a week before our one-to-one session. I was like, oh gosh, yeah, I can see that wins on your face, Chigo. So you know that feeling. Yeah, she was a consultant in the hospital. I don't want to say her specialty because some of us might know her. And she was thinking, well, if only I knew, maybe how much could I have saved her in terms of buying it through your limited company? We're talking about thousands here. Obviously, it's not the whole 50-something thousand to save her. To save her at least that tax, 20% tax that I've paid in limited company. Again, beyond the scope of this discussion, let's not delve into that. Okay, so that's one thing you can look at. Then there's pension, obviously. We've mentioned it. You are allowed to open a private pension if you want. And I was very pleased. My last seminar, which was organized by, I think it was a UNN medical alumni. Thankfully for me, a pensioner was there. And when I finished my session, he said, "Thank you for everything you're saying. I wish someone told me this thing when I was still working. And listen, you guys, I actually had a private pension. Not that I knew what I was doing, but I saw people doing it. I just did it, and that saved my bacon. Now I'm in retirement. Kestama has turned off our heaters, according to them, but because he had like a private pension. So in this country, you are in the UK. I believe everyone here is listening from the UK. Recently, I've been having a lot of sessions from people in Canada, especially British Columbia and Saskatchewan. I don't even know where that is. In this country, you're allowed £60,000 pension allowance. as a while ago when I said Moneywise Doctor, which is not that long ago, like almost 2 years now, the pension allowance was £40,000. And for those that don't understand, it means that you are allowed, the government allows you to take money that you make and put as much as 40,000. It was then, now it's 60,000. You can put as much as £60,000 into your pension, and the government is going to look the other way. Basically say, we're not going to tax this money. So that means just like your NHS pension, the money goes out first before tax. It makes a massive difference. That means that before the government, especially as you are a GP, probably you're paying 40% or a bit more in tax. So, but before your salary job, but before the government could actually take that half, you can have the opportunity of putting a bulk of it in your pension. The question might be, well, I need the money now. I don't want to put in my pension. But that's where planning comes in. You're having a clear financial plan. What do you need the money for now? Could you get the money elsewhere? Could you spend the money from your company in something else? Yeah, but some people might say, well, I can put 5,000 in my pension this year. You still have your NHS pension still going. Or someone could say, I could put £5,000 extra in my private pension. So again, by private pension, I mean things like self-invested personal pension, like SIP. If you check SIP, Moneywise Doctor on Google, you'll see an article I've written on it. If you check it on YouTube, you see a video I've done on it. If you want to discuss it further, ask me any questions in the chat or in the YouTube or in the Mastermind, and we can go deeper into SIP. But you can actually take money from your limited company and put it in your pension, private pension. Obviously, it's not money you can touch now. It's money for the future. And if you think you're very far away from retirement, depending on your age now, add 20 years to where you are now, and then look back 20 years to where you were at 20 years. You might realize that 20 years is not as far as it looks. And for some of us, retirement is closer than we think. Okay, helpful?
Yes, absolutely.
Lovely. If you look through that article, you will see a list. I've actually got a full list. Life insurance, home office costs. For instance, I have a microphone that costs quite a bit of money. I don't know why I bought it. I bought it for almost 4 months now. I'm just learning to use it today because I'll be visiting a friend of mine as a podcaster. And some people just think it's the best in class. Apparently, it turns out that buying expensive technology doesn't make you better at using them. So I've actually just stuck to what I know. So, but you can actually buy equipment, printer. I've got a printer next to me here, scanner that you need to run your business. Those things are deductible. Travel and accommodation expenses. Sometimes you need to travel for a conference, for your business, or for medical reasons, as long as it's related to your business. If you hire a staff, I don't see why. I feel like if you're making above $100K dollars or pounds, you can hire a PA. I've got like you can hire a personal assistant or personal business secretary, or hire an admin person. Just you think you can afford them, you will be surprised how much stress they can save you. And also you can actually deduct their salary from your tax, through your limited company. Of course, if your limited company doesn't make a lot of money, you don't have to hire somebody, but these are just knowing that you've got that options. If you pay your accountant, you can deduct that money through your limited company. Obviously, you've got bank draft, interest, hire purchase expenses. If you pay your professional indemnity, GMC, and all that stuff, you can pass them all through your limited company. So there are quite a few things. I like to, because Christmas is coming, the geese are getting fat. Please put a kobo in the old man's heart or penny. So Christmas is around the corner. It's always a good time to be charitable and support other people. So I want to remind you that if your company donates to charity, so we sponsor organizations, sometimes we sponsor even like our Nigerian doctors in the UK and other organizations and charities as well, that actually like including religious bodies. If you take your money and put inside any of those charities to support them, you can deduct them as expense. It's not taxable. So there are so many ways to skin, and these are elementary methods. There are more advanced ways. When I speak to some financial advisors, doctors who've gone ahead, there are so many other advanced strategies. Some people buy a property. Your pension can buy a property. So I've got a financial advisor who used to be a banker. His personal private pension, he used it to buy a property, and then his business as a financial advisor rents the property, and the rental money is going back to the property. Again, some of these are not meant for YouTube or public stuff, and I can't wait to see what we'll do in that mastermind anyway. over the next 12 months, we're going to be going a bit more deeper into some of these things. But I hope that helps. Maybe we
Yes.
should get someone else to ask, except you have more questions.
I think his last one is about dividends being backdated for the previous tax year. Or has he already answered it for you?
I don't
Yeah,
think
that's
so.
the only one not answered.
So what was the question? Could you explain it for me?
Okay, so the context is basically my limited company was just opened before the end of the tax year, and then we've gone into another tax year. I didn't know anything then about dividends. Now I'm scratching my head. They've dropped the value for dividends for companies, isn't it, to 500, and I could have taken out 1,000 in the past tax year. So I'm wondering, is it possible to still create an expense and say dividend from the previous?
I think this might require a bit more technical help from an accountant, okay, because there's been some tax rule changes, but something that might be helpful. Your company filing reports don't follow the tax year. So tax year, for me as a person, my self-assessment, I've got to file. You have to declare by October. If you're going to do self-assessment, you have to tell HMRC. Many people don't know. You have to tell them by October that you're going to do self-assessment ahead of April. So for me as a person, for you as a person, April 5 is the end of the tax year. But some companies file in January. It's 9 months from when you started trading. That's when you file. So have a chat to the accountant. If you've got a good accountant that is clever and honest, clever and supportive and honest, they can help you legally, figure out how to do these things. Dividend tax allowance is 500. It used to be 1,000. Believe you me, I think it used to be 6,000 at some point. Did you know that? It's changed quite significantly, and it's not a long time ago. I don't know if you have time, you can Google it. You can say how much was dividend tax allowance. That's for those of us who don't understand. Is basically the money you can withdraw from your business before you start paying tax. So how much was dividend tax allowance? Let's say in 2015. Let's see what that was. Yeah, nothing is coming up here. But basically, capital gains and dividend tax allowance was quite much. It was far much higher than it is now. At some point, it was up to £6,000. Maybe we can have a look at that later. Basically. So it's usually so small now that I don't think it makes a massive difference. One of the biggest areas you can actually get a lot out of your companies to expenses, maximize all allowable expenses, and then whatever is left, you can look at, okay, how do we dish out the dividend? Now, I think I'll share this here, okay? Remember, you can be the director of your company, the only director, but that doesn't mean you have to be the only shareholder. So if you suddenly find that you're going to end up with a massive dividend and dividend tax, what if you have other shareholders? They are owners of the company, and there's nothing against having your spouse or family member or, to be part owners of the company, as long as they are owners of the company and you have all agreed that they are owners of the company. Not staff, not director. If they're director, they've got to do work to get paid. But shareholders, that means that they get a share of the dividend, whether they are in the UK or US or Ghana or Cameroon or Nigeria, they could actually be shareholders in the company. So you might end up with 40% of the dividends. They end up with the other shares. They have to pay tax wherever they are based. And you have to pay tax where you are based because you are based in the UK. The UK government doesn't go to someone in Abuja say, what's going on? You haven't paid tax on your dividend, because they're under a different jurisdiction. Again, something to discuss with the accountant. If they are clever and honest, a lot of accountants are very good in balancing a book and doing all the good stuff, but your accountant is not just there to tell you what to do. You have to sometimes tell them what you think should be done and push as far. Then they will tell you, no, this is the boundary. That's my experience. I've actually gone on meetings. I remember in 2001, I've taken my accountant to a meeting because I went to talk to what will I call it? Is trust, not for trust per se. Let's just say estate planning consultancy. So they're experts in how to, plan your estate, your property, your will, and put them in trust and all that. I had to take my accountant to listen to what they were saying so that the part I understand, I explain to them. The part I don't understand, they explain to me, and then we can make a plan. My bill to talk to that group for 45 minutes was about £450 plus VAT. And then for them to do the job for me was £17,100. We did eventually go with them, but just to tell you that tax planning, estate planning is expensive. And if you can do some things by yourself, by just having the knowledge, go ahead and do them. There's a reason why the rich and powerful eventually don't pay a lot in tax, and all the big taxes end up with middle class like us doctors. Yeah. All right. Well, thank you for all those powerful, insightful questions. I think you've asked questions that allowed us to touch on so many things, and I'll be very interested to hear what other questions people have, or if you have questions based on the questions I've answered.
Thanks, Odekunle. I think
Thank
we
you very
definitely learned a lot from your questions. Next up is Maduka. Maduka, are you here?
Yes, you can go ahead and ask the question. Thank you.
Okay. He asked if a person gets income from Nigeria, example from running a business in Nigeria while living in the UK, is that person required to pay tax on any other payments to the UK or any other payments to the UK government regarding the income?
Thank you for that question. I think there's a difference in the questions we've been getting from the first 3 sessions and this 4th session. They're a little bit more advanced, which is great. I love it. Madika, I'm going to be honest with you. I wish I could say no, but yes, you are required. Actually, the last Tory government, our Tory government, the ones that just left, Rishi Sunak's government, they are the ones that came in with this whole non-dom tax. So non-doms, for many years in the UK, non-dom is like, okay, if you live in the UK, but you're actually have property, you're actually registered as somebody who is not domiciled in the UK, but it could be a UK resident. You can have property abroad or family property and businesses, and you're not required to pay tax on them. Then just before the last government left, I actually talked about this in one of the budget presentations. So the new rule now, and obviously Labour has tightened it a little bit, is that if you make money abroad, you're supposed to repatriate it and pay tax in the UK. So obviously they require you to declare the assets and the profits you make and pay tax on it. I think the Tories were going to kick it into place in 2026 or thereabout, but I think they've brought it forward now. So the most important thing is that if you have significant income that is abroad, that is in your name, then you might want to have a chat to an accountant about the tax situation. Basically, the non-dom describes a UK resident whose permanent home or domicile for tax purposes is outside the UK. Most of us are not affected in that respect, because if you are in the UK as a full resident and you're a tax resident and you're going for an ILR and citizenship, they're assuming that you are domiciled in the UK, so you are required to pay tax. I don't know how much people declare in what they have in different countries. Again, I'm not a lawyer and I'm not a tax person. I'm also not an accountant. But yes, it seems you have to pay tax on them. Have a chat to the accountant. If they're clever and honest, they will help you, especially if they're courageous.
Sorry, and can I just quickly ask a question with regards to this?
Of
So,
course.
for example, okay, if you have citizenship in another country that taxes your worldwide income and you're presently a resident in the UK, how does that work tax-wise? Because you're still, even though you're resident in UK right now, you're still taxed on your universal income in another country, which is not Nigeria. So in what way does this now work? Is it that you have as an investment in that country? So in what do I need to declare that in the UK too, or as in, because I don't know.
Very, very, very technical question, Tolu. And that question tells me some answers. It tells me that you or whoever it is a US citizen. That's the country that does that. Actually, I have a pen in the backside form here called W8BEN-E. that I've been trying to fill out since. I'm not a US citizen or anything, but whenever you do business with companies in the US, as an individual, they want you to fill out this form called the W8BEN, or as a company, like in my case, they want me to fill out W8BEN-E to say I'm not a US citizen for tax. I'm not like tax resident in the US. So US is even a bit more aggressive in their tax. But if you're a US citizen, like if you're kidnapped in Somalia or somewhere, they will send the Marines for you at least. So if you're a US citizen, you are due to pay tax in the US on some portion of your income. And if you're a resident in the UK, you are also due to pay tax. However, you can choose one. You can decide to be primarily tax resident in one country, and those taxes would affect you more. Something in the public recently was our dear former Prime Minister, Wealthy Rishi, who I have nothing against per se. His dad was a GP. I know some people will say, oh, you're too rich. I'm like, well, I don't know. Is that a crime? But there was this issue that he was resident in the US. He had a US green card, and his wife was American, and that meant that they were paying US taxes, which was lower rather than UK taxes. Okay, so it made so much scandal, and he now decided, okay, going forward, him and his wife, they were going to pay taxes. I think it's the wife that was affected. They were going to pay taxes in the UK. So yes, again, this is one of those technical things that might be helpful actually to just chat with an accountant who is well versed in that area, not a regular accountant, maybe probably an accountant who has some specialist knowledge in that area, not for knowledge sake, but for implementation. If you do have assets in both countries, being able to file it properly in the way that it is to your best financial interest does require a bit of help. So yes, if you're a US citizen, am I correct in that actually, Telu? Are you a US citizen?
No, it's not the US.
Okay.
But it's still worldwide.
Okay, I missed. I don't know many other countries that do that anyway.
I think Canada does it too.
Oh, Canada does it. Wow. Yeah, quite Canadian about taxes. Actually, if you go to moneywisedoctor.com, we've got like accountants basically. They don't work for us. Basically, we recommend them if we think they're any good. So there's a link. You could actually go fill out the form, and they'll usually get in touch with you. If they can't help you, or if you feel they're messing you around, if you let us know, we'll take them off our list. If they can help you, then that's brilliant. You come back and tell us, you leave a review for them, and that's brilliant. Every now and then they save people a lot of money. I've always used an accountant from day one since I started working in the UK. I think it's one of the best money I spend. I spend a couple of £1,000 every year on an accountant for my person and my business. I don't complain. I always hear people say, oh, I'm going to spend £200 for self-assessment. Oh, what are you talking about? It's going to save you a lot of money as well. Yes. So Telu, better. Okay. Does that help?
Yes, that helps. But I have another question about this self. Like now, if someone is not up to that level of self-assessment in the UK, is there any need to use an accountant for anything? Because no, okay.
No.
The other things you can just do that the one that you put about your exams and everything.
Yes.
Okay.
So if you've gone to check the list I've made, that criteria, and you don't meet any of the criteria to do self-assessment, then there's no need to spend money on an accountant. You can claim back your tax relief with our step-by-step guide. Maybe use the video. Again, that is now one of the most watched videos YouTube, not surprisingly. You can use the video guide to claim it back. But once you meet any of those criteria, your income starts heading towards a certain direction, then self-assessment is a good idea.
Okay.
Thank you.
Thank you.
Next up is David.
Hi, David.
Hi, good evening. Thank you so much for all the insights you've been giving.
Good to have you. I always recognize some names, either from the email list or in the community and previous event. It's nice to have you, David.
Thank you so much. My question is this. setting up a limited company. My wife and I are both doctors, and my intention is, well, we don't have the company yet, but before they start designing, having the plans on ground. And someone mentioned to me that rather than both of us being directors in a single company that is not tax-wise, because we'll be taxed double, that is rather, it will be better she has her own company, especially if she wants to do like locum or other things. And then I have my company. And then with that, we can take more money out to do other things rather than both of us being trapped in a single company. I don't know. I don't want to get your advice on this. I don't know if it makes sense.
Yeah, David, the question makes sense. I'm not saying that the suggestion makes sense, but the question you asked makes sense. Is this person an accountant?
No, definitely not. No.
Do you have any reason to believe that they have any clear understanding of how taxes and limited company works in the UK?
Well, the person has been in the UK for over 20 years.
No,
Has
it doesn't.
company with a husband.
Yeah.
And yeah, she just advised that it's better than both of us. And well, I'm not too sure.
Yeah, I'm sure they meant it well, but I think one thing I learned after I came to the UK is that,
Yeah.
and then went deep into the financial system, that a lot of people have made a lot of assumptions, even they've been in the UK for 20 years or 30 years. And those assumptions were not based on facts. So if you want to look at the facts and the numbers, what possible advantage could be there? If you do limited company because you do medicine and your wife does medicine and you both work together in the same limited company, then you have a higher chance of actually doing a better tax planning inside the company. If your wife possibly or you is doing a salaried job, you're a consultant or GP, you're getting a salary job that is paying you so high, then it might not be in the interest of one of you to be a shareholder, because then you're going to get more money from the company that will push you further into a new tax band. But if you're already both locum, or well, you're going to be in that higher tax band anyway, you might actually find it more useful to work together in a limited company, reduce the expenses in terms of filing, the cost of an accountant, and also you can also have a bit more flexibility. Example, directors of a limited company could sometimes be husband and wife. The guy that was on my next podcast, he was an anesthetist doctor, finished his training, then went out to start this health tech media company that now generates over £1 million per year. He's got 20 staff. His wife is his co-founder. They could actually be directors in a limited company. Guess what? They could decide to have a company retreat in Australia. Company retreat. I didn't say holiday. Now I said company retreat. You didn't hear me say holiday or honeymoon or anything. Company retreat in Australia. Again, your good accountant will tell you what is allowable and what's not allowable. But if you have a different company, that might present some issues again. So I don't know any great advantage in husband and wife opening two different limited companies if they intend to work together. Because, for instance, if you needed to take your pension as a director, you can take yours in the same company and your wife can take hers, okay, or your partner or your spouse, whichever it is. If you needed to pay life insurance, you can pay yours and your partner can also pay theirs at the same time. If you needed to pay, let's say, expenses and you incurred expenses, you can both pay your expenses. If you need to hire staff, if a company of 2 people running it hires 2 staff, it sounds reasonable if you even hire 3 staff compared to when a company of 1 person hires 2 staff. Yeah, so there's economies of scale there. If you need a lawyer, you can have just spend the same way you spend for an accountant, you spend for a lawyer, if you ever need any of those things. And both of you can actually be more tax efficient, basically, because in the UK, if you approach tax as a family, you tend to have more advantages. Again, chat to an accountant. Many of them will chat to you for free. Limited company, you can open it tomorrow or on Monday, £12 it used to be. I don't know what it is now. Chigo, I think you did one recently. Did you do it yourself or use an accountant?
I did it myself.
You did it yourself. Wow, okay. Good. How much did you spend?
To open in the company house.
Yeah, company house.
£50 now.
50. 50, 50. Wow.
Mhm.
No wonder my accountancy bill is rising. Okay. Used to be £12, right? But I never
Ahead, yeah.
I used to pay my accountants £50 because I thought, well, they're experts. I can't afford to make one tiny bit of mistake because I'm busy with other things that pay me. So if it's £50, that means my accountant are probably charging me more. Yeah. Yeah. So David, yeah, have a good think about it. And I think if you wanted to, there's always the option of starting with one. So both of you can start with one, see how it goes. And if along the line you learn some secret that we all don't know about, or some any advantage that you think you can get, then you could obviously let us know in the group. But I don't know any additional advantage you could get by having different limited companies. I know that there is something called so there's VAT, but that VAT doesn't affect you as a doctor if you earn above 85,000 or the equivalent of $100,000 in a business in the UK. You're required to start collecting and paying VAT, but that doesn't affect people in healthcare. If not, you would have said, well, it was better for us to just split so that none of us is having to pay VAT. But that doesn't affect healthcare. And then if you also check other things, if you open a different company, your wife opens a different company, these are different entities, but it could be easy to associate both of you. If you happen to own property, own different assets, own the same address. So separating it in terms of legal purposes might not offer a lot of defense. So these are a few things to think about. And again, if you find something that we don't know, then please let us know. But I can't really think of any advantage of opening multiple companies, except when the businesses are different. In my case, I've got businesses that do different things. So they have different entities, different companies. And those companies are not me. I'm just the one controlling them. Okay?
Fantastic. Thank you so much.
All right,
Thank
cheers. And good luck
Yeah.
with the company.
Thank-
Who's next?
Thank you. Thank you.
Next is Fola Shade.
Please, go for it.
Are you here? Should I ask? People are asking what opportunities are there for doctors 45 years and above, since ISA is for younger doctors.
That's a fair question, and that's a question I'll probably be asking very soon, in a year or two. So ISA, lifetime ISA does not start at 40. I say that life does not start at 40. So lifetime ISA does not start at 40. If you've crossed 40, you can't get lifetime ISA. But there are 4 ISAs. Lifetime ISA is just one of the ISAs. Every other ISA is available to you. You can use the cash ISA. You can use the stock and shares ISA. You can also use the innovative finance ISA. The stock and shares ISA you can use for investing. So if you want to invest, as long as you are living in the UK, you're above 18. I think 18 is the cutoff. As long as you're above 18, you can open a stock and shares ISA. Many of these apps you use for investing that people use, if you try to invest, the first thing they will show you will not be a stock and shares ISA. I've fallen victim to this many years ago. They just say invest, CFD, stock and shares ISA will be somewhere. So if you start with that invest, you end up with a general investment account that is liable to taxes. But with a stock and shares ISA, you can invest tax-free, £20,000. That means that, just to help you understand it, if that £20,000, if you are fortunate, for instance, I gave an example that last year, I think we did 85% or 87%. I can't remember now. So that means that all that money, if it's inside the stock and shares ISA, there is no tax on it, no capital gains, no dividend tax. Okay. Now, let's say next year you still don't touch that money. You put in another 20K or 5K or 2K, whatever you can invest, and it grows. There's no capital gain, nothing. You do it after 20 years, there's going to be a massive difference between yourself and somebody who wasn't using a stock and shares ISA, or who was just investing their money just naked without the protection of an ISA. Okay, so you still have access to a stock and shares ISA. You're eligible to have one. You still have access to a cash ISA, which I think is only good for me. I think it's only good for saving money that you don't need to invest immediately, which we call what? Can somebody help me? If you're saving money, Chigo, you said that.
Emergency fund.
Emergency fund.
Thank you. So your emergency fund. So a lot of doctors, I've met doctors, especially I had an A&E consultant, lovely lady in my one-on-one session. I think she was still quite young, But over the last 7-8 years in her training, and she's a relatively new consultant, she's been saving 50% of her salary, 50% of her income. So she's not invested. She's just a little bit scared, didn't know where to start. But it's almost as good as lighting money on fire or putting, because of inflation, isn't it? So it's better than not saving, but inflation has touched a lot of it. So I would say, well, you want to save 3 to 6 months worth of your living expense first. That's your emergency fund. And then you can start investing, knowing that you have that cushion. You have your emergency fund, you have your financial protection, your defense plan, which includes things like your life insurance, income protection, and obviously any insurance you need to get, your house insurance, your MDU, you've got your emergency fund. Then you can venture further, invest in a business, invest in companies, invest in real estate, or whatever floats your boat. I mean, if you want to learn more about ISAs, I've got a very detailed video. I think is the second or third most visited YouTube video on our channel is on ISAs, where I explain everything. I can't really find it at the moment, but hopefully someone will find it and share it if you can manage.
I'll find it.
Either the blog or the video. If you share it, then you can have a better understanding of ISAs. So you can still use the cash ISA, you can use the stock and shares ISA, and you can use the innovative finance ISA if you want to start getting a bit more into deals that involve investing in entrepreneurs and new businesses that are a bit more risky. All right, thank you for that. But that's not all. So you are also entitled to pension. Remember, you're entitled to pension. So you could actually put in quite a bit of money in your pension, and you can cash out that pension at 57 years. It's actually 55 years now, but in 2028, they are going to change it. Okay, thank you for sharing. In 2028, they are going to change it from 55 to 57. Yeah, so you can also put in money into your private pension. So these are some options available to you. They are not the only options, but they are really good starting points to have that good, strong foundation before you then go out to invest and do other things. Okay, I hope that helps.
I've shared the YouTube video.
But could I ask everyone here, if it's not too much trouble, I'm just going to ask your indulgence, it's not payment for the session, to go to our YouTube channel and just click subscribe. Just to make us happy. If you click on subscribe on YouTube channel, I think it's Moneywise Doctor YouTube channel, will come in and say, oh yeah, I've got like a couple more subscribers, and that's really nice. Okay, we've got 2.5 now, and we like to see it grow. It just makes us, it fans our ego. That's all. All right. Okay.
Thanks, Igot. Igot has subscribed. Thank you.
Oh, thank you, Igot.
Next, we have Chantel.
Okay, hi, thank you. Thanks for the link. I'll go through it as well. But can I piggyback on Folashade's questions about ISA? So just to clarify about cash ISAs, are you taxed on the profit on that? Because you said, yes, stocks and shares, you're not taxed, regardless of how long you have it and how much you have in there. What about cash ISAs? Second question about ISAs as well. If you've had a lease and you've used it for your property, can you still put money in that? You know, you've cleared it to buy property. Can you still put money in that?
Absolutely, banger questions. Thank you for bringing them up. I'm glad you have them, because probably we do have so how this thing works is your questions actually direct how we go. So yes, absolutely. If you put money in your cash ISA, it's tax-free. And this is really important, because I've seen a lot of doctors. I think I had a few colleagues now. I've had 3 or 4 who inherit a bit of money. Believe it or not, people are inheriting money. So I've inherited good values, integrity, and hopefully a good name. But somebody has inherited quite a bit of money. I've talked to a number of doctors who were fortunate to be in that position, and they didn't know what to do. They just stuck the money in the bank. So they were making interest on that money. So they didn't realize they needed to pay tax on it until they go to do self-assessment or something comes up. I've had times when HMRC has requested all my bank accounts and I send it to them. They'll go through it. Well, there's nothing I'm owing here. So if they come to that point and realize they're making interest on that money, not even a lot, 5% interest, and you're making interest on it, that is liable to tax. But if you have it in a cash ISA, as you did ask Chantel, really important question, is tax protected. Anything ISA is a tax wrapper. ISA is not an investment, because people ask me, should I invest in an ISA? I'm like, no, that's not the right question. The ISA is not an investment. The ISA is what you wrap the asset first, then invest it. So the short answer is no. There's no tax on cash ISAs. However, if you save your money outside the cash ISA, it's very easy to fall into having to pay tax, because if you're getting 5% on 10,000, that's already £500. I don't know how my math is off here, but if you're getting 5% on 100,000, it's 5K. So if you're getting 5% of 10,000, 500. The saving allowance at which you start getting taxed is 500. That's not a lot. Yeah, I know some people, it might be a lot for some people, but for most doctors, 500 over a whole year interest and then you're taxed on it is not ideal. Your second question was about lifetime ISA or LISA. Yes, lifetime ISA is only good for two things: for buying your first house or investing for your retirement. Obviously, there is LISA stock and share, the LISA cash. If you bought your first house, you can absolutely continue putting money in your lifetime ISA. The most important thing is that you've opened it before you were 40, so you can continue using it. Once you cross 50, you can't put any more money in your lifetime ISA. 50 years is the point where you can't really put any money in your lifetime ISA, or if you end up in Canada or New Zealand or Australia, all those places, a lot of GPs are going these days. If you're not a UK resident, you can keep it open, but you can't put more money. But here is the twist with lifetime ISA. You can't touch the money till you turn 60. So understand, NHS pension, you can't touch it till you turn 68 or 65. I think it's 68 for most of us here. Lifetime ISA, you can't touch it till you turn 60. And your private pension, you can't touch it till you turn 55 or 57 from 2028. So knowing those things could actually come into your tax planning projection. You can work out, when will I be able to drop a couple of sessions? When will I be able to stop working? When will I be able to, go for it and start that company or dream I want to do? Or can I start it now rather than then? These are all really important questions. Okay. I hope that answers the question, Chantel.
Yes, it does. It does, actually. Thank you.
That's brilliant. Are we already midway? I think we're almost midway.
Yeah, I think we have just one more person. Two actually.
I think I'm going to share some more details, things that has not been raised, but I think are really, really very important for doctors, healthcare professionals in the UK, especially going into 2025. The government has introduced some tax rules, which some people have not realized the massive impact. After this budget was released, I was one of those who was on YouTube and sort of like making noise about it. It took maybe 2 or 3 weeks for the country to eventually wake up to it. Now there are farmers rioting and people are doing all sorts of things.
Before I go over to the next person, Chantel, I know you mentioned the 60% tax trap. I don't know if the link I shared is okay for you, or if you had any specific questions to ask on it.
Well, I haven't had time to read the link. I have an idea, really, but I was just discussing with a friend.
Yeah.
And, one of the ways they said you could avoid that tax trap was to do like a private, a personal pension plan, really. But I wasn't all for that. So I wondered if there was other ways, you could avoid it. So that was...
That's a valid question. Basically, 60% tax trap. Does everyone understand the 60% tax trap?
No, I also wanted to ask about that. So it's the same question. Should I just ask mine so you answer it together?
Yes.
Okay. For the SIP, okay. For me, for now, I will still grow to this higher stuff you've talked about. But for the SIP, let's say I'm not sure my money will get. I'm at the border, and I am scared that I would cross the 100%. So when should one really start contributing to that to avoid it? If you want to use the SIP, should I do it when I'm sure I've crossed the border, or I should start doing it little by little, just to calculate, oh, I'm going to earn 104, so let me put 5 so that I will drop to 99. I want to just know how to do the contribution if I want to use that as a leverage to reduce the tax. Thank you.
Excellent question. Again, some of the questions I'm getting today, I love them. They're sort of like higher level questions. But for in the interest of everyone present, I've posted a link to nhsSalaryCalculator.com. It's a free website. We built it to help doctors calculate to know when they're about to fall into the 60% tax trap. If you start filling in your income there, once you hit it, it will flash up for you. Okay. And you can also check out what will be the impact, whether it can help you with, if you put in more money in your pension, you see whether you've come out from that tax trap. So it's a free website, nhsSalaryCalculator.com. It was sponsored by MoneyWiseDoctor.com, and it's free for all NHS staff and any other doctor, or even any professional in the UK. I'm very pleased to see that 3 or 4 content creators on YouTube have made videos about it, so you can have a look. Is in the description.
Yes, here's something quick and useful. If you ever wonder what your actual take-home pay is after taxes, NI, pension deductions, or you just not sure how paying more into your pension will affect your take-home pay, our free NHS salary calculator will give you a clear, instant breakdown. It's perfect for planning your finances, checking deductions, or even spotting overpayments, and helping you determine how any changes in your pension contributions can affect your take-home pay. You want to make sure you're taking enough home. Now, it's easy to use and it's tailored for NHS professionals like you. You can try it now for free on nhsSalaryCalculator.com. So it's nhsSalaryCalculator.com. The link is in the description. Now let's dive right back into the episode.
The other thing I wanted to share with you was MailChimp Moneywise Doctor Task Guide. So it's also in the chat. If you wanted to join, if you're in the newsletter, I can share it as well. It's just a free guide you can download for the 60% tax trap. Now, to answer your question specifically, as usual, I need to explain what is the 60% tax trap. If somebody has heard this for the first time and you're wondering, what do you mean the 60% tax trap? After all, everyone in the UK pays taxes at the maximum is 45%. Well, there's this thing called personal tax allowance. So everyone, including, by the way, I'm here till 10, okay? I promised in our community group, on our private community, that I was going to hang out till 10 instead of 9:30. Feel free to go by 9:30 if you need to go. But a lot of the juice comes out towards the end. So the 60% tax trap is basically this. You, Esther, and myself, everyone in the UK, you're entitled to what we call the personal tax allowance, £12,570 before you are required to pay tax. Okay, so if you are working in the UK, you are entitled to £12,570. So any money you earn below that, you might wonder why a lot of limited company owners are earning £12,570. Is it a magic number? That's the number at which any money above that, you pay taxes on it. Okay? Is that clear to everybody? Just give me a nod or a thumbs up if that's clear. Okay, that's clear to a handful of people. Good. Now, okay, thank you, Joshua. Thank you, Madika and Chigo. Now, above a certain income threshold is £100,000 actually, roughly. It's slightly, just a little bit above £100,000. Above a certain income threshold, then above that 100,000, for every £2 you earn above 100,000, you lose £1 of that personal tax allowance. So each time, let's say you make 102,000, sorry, or 100,002 pounds, very strange number, you lose £1. As for every £2, you lose £1 of that personal tax allowance from the bottom. So by the time your income reaches £125,140, you have effectively lost the entire personal tax allowance. So effectively, you are paying 60% in tax. Your effective tax rate is 50%, 60%. Not to mention the other issues it could cause. Obviously, if your taxable income is above 60K, that's your adjustable net income is above 50K, you can also have to be hit with the high income child benefit charge, which is another discussion altogether. So this is what the 60% tax trap is all about. Who are the people affected? Obviously, doctors. Because if you're a doctor, you're not yet earning 100,000. you're still on a journey. Probably you're a trainee or you're working part-time. But most full-time doctors, like a consultant, you finish your training. So we're assuming you're now a full-time doctor, you're a mature doctor, you are a senior doctor, or you're a GP. So you're working like 4 to 5 days a week. You earn closer to £100,000. So it tends to affect people like that more. Okay, that's why if you go to YouTube or Google and Google how to avoid the 60% tax trap as a doctor, you see an article written there. It comes up on the #1 page.
Here's how to avoid the 60% tax trap as a doctor or healthcare professional. This could actually literally save you thousands of pounds because you could be unknowingly paying an effective tax rate of 60%. Now, many doctors think that the most tax they pay is 45%, but that's not right. You may have fallen into the 60% tax trap due to a sneaky rule about personal tax allowances. Now, let me tell you how it works. Everyone, especially in the UK, Northern Ireland, England, and Wales, has a personal tax-free allowance of 12,570. Once you exceed 100k in income, you start to lose that tax allowance. And by the time you hit 125k, it's almost like you're punished with this sneaky 60% tax because your effective tax rate becomes 60%. You've lost all your tax allowance. Now, I've done a guide that will tell you step by step how this works, a checklist to check if you are falling into it and how to avoid it. Thousands of medics have already used this guide to save thousands of pounds and secure their financial future. Don't miss out. Download the guide with the link in the description, and I hope it helps. Let's jump right back to the episode.
Now, the most powerful way to fight against that is pension. And that does not only mean private pension. It could mean increasing your pension allowance, your NHS pension allowance, increasing it, making sure that, okay, you are contributing the maximum you can contribute. Because a lot of you think that the pension that is taken from your money into NHS pension, that's the most you can contribute. No. You can actually contribute more, but you've got to ring them and ask them to increase your pension contribution. Because I've gotten a few people do this and they say you can put in an extra £8,000. Now, if you're a GP partner, is there any GP partner here? I think I saw one who I've done one-to-one with, but I don't want to mention the name because I do sometimes have sessions with GP partners, 20 at a time. GP partner, you're already paying pension into your own pension as an employee, but you also pay as a business owner. So you probably pay more into your pension than most people. Even that will not scratch the surface of your pension allowance, which is what? £60,000. Okay, your pension tax allowance every year, you're allowed £60,000. I said it at the beginning. If you need any help in that area, ask in the chat or check out SIP on Moneywise Doctor. Now, you could decide to pay more, either pay more from your NHS pension or open a SIP and pay more. That could be the one way to fight against it. If you are not sure yet whether you have already reached that, don't panic. There's a rule many people don't mention, especially financial advisors. You can pay back your pension in this country. You can go back 3 years and pay pension. Did you know that, Esther?
No, I'm just hearing this for the first time.
Okay, that's good. There's a lot of first-time things. So you can actually go back 3 years and pay your pension. It's all there. Now, this is my challenge, especially with us as doctors, that nobody really tells us these things. And these are things that are life-changing, their life. They can impact your finances significantly. I think it's a good opportunity for me to mention here. I don't know how many of you already know that next year we're going to be running a mastermind for doctors. It's not going to be we're not able to take more than 20 people really. It's going to be a mastermind for doctors who are really looking to really tighten up things. And we're going to start it from December and run it till next year, December. What it is like 20 people who are going to work with me in the Moneywise Doctor community, private community. We're going to come together, look at things like we've discussed about, things like your taxes, your limited company, 60% tax wrap, insurance, investment. In fact, we're going to do an investment master class. It's going to run for 4 weeks. I think a couple of people here, 3 or 4, have been to our investment masterclass this year, and I'll say you can attest to what it was like. Esther, what was the experience in the investment masterclass? Did you find it useful?
Yes, I found it very, very useful.
Okay, yeah, I think Chiga was there as well. So that all that together, the investment masterclass is all going to be bundled into that mastermind. So it's going to be available on Black Friday. We're going to release it on Black Friday because we want to give everybody a chance to be able to get on it. Currently, I think there are 140 people on the waiting list. We're going to release it Black Friday, so midnight on Thursday. Probably send out the email, or when you wake up in the morning, if you've got a slot, you might still be able to reserve a slot. But you can't really get on it without getting on the waiting list. So there's the waiting list. In addition to the master class and also being able to learn from experts in the industry, you can bring in an accountant or life insurance advisors, bring in experts in NHS pension and experts in things like financial advisory industry. We're going to provide all those things. So those 20 people are going to be working with me directly. You meet with me one-on-one 4 times in the year. That's all going to be bundled together in that mastermind. If it's something you're interested in, go ahead, check it out. I've posted the link in the description here for you to have a look. If it's not something you think is for you, don't worry. We've got like 300 free videos on YouTube. We've got like 60 blogs. We've got a lot of information. We'll continue to support doctors and healthcare professionals. This is just for 20 people who think, well, I want to really make 2025 the year I actually started my journey to financial freedom or got there. If you know my own story, you know it didn't happen automatically to get to the point where I got to. So if you want to really think, okay, it might be that the investment masterclass is the main thing you're interested in, that is going to be part of that bundle. The 4 weeks investment masterclass, that's going to be part of that package. In addition to your 4 sessions one-on-one with me, access to the whole library of videos and books we talked about. All right. So that aside, I think we should crack on. If you ask in a YouTube or blog post, I'll do my best to answer. But for you and those of us that are already in the premium community, go and work it out. Bring it. We'll all work it out together. I make videos sometimes on the go to answer questions. So go in there, plug in some numbers, play with it. And even if you think, oh, I might not find out till it's too late, don't you worry. You can pay your pension 3 years back. Yes, you can pay your pension 3 years back. So that's a few things that nobody really tells to us, but knowing it sometimes could actually mean £100,000 difference for you over the course of 10 years. Okay, right. Okay, I think I've got I don't know who is next. I see Oyetola raising her hands. Who was the other person?
The next would be from the chats. We'll get to Oyetola soon. She has 3 questions to ask, I think.
No worry.
Yeah, so my first question is, how do you go about putting on your real estate in trust? And can you put buy-to-let properties in trust? And if you're letting properties, is it better to just let them privately or use a limited company? Because I've gotten various advices on both. And then piggybanking on all the tax issues, because now depending on your income as well, savings under your children's names, you have to declare, and at what level are you going to be taxed for, and how do you work around that? I know you could do junior ISAs, but where they already have non-junior ISAs accounts, what's the way around that?
Okay. It's very key questions, Maori. I think we should start with the first one. The first one you asked was what was it again? It was about properties, isn't it?
Putting properties in trust, including
putting properties in trust. If you don't mind, I'll address life insurance in trust first, which is the easy one. You can put your life insurance in trust. If for those of us who don't understand, putting it in a trust means you put it outside your estate. There's a big issue going on now. Farmers are up in arms in London. Well, I don't know if they're still there. They're angry with the government for actually including the farms into inheritance tax as things that will be considered for inheritance tax. The government also put in pensions. Most of us don't even know what is about to come, right? That means that pensions are also part of things that assessed for inheritance. Now, putting something in a trust means you put it outside your estate. So what can be taxed for inheritance tax? So if you put your life insurance in trust, it means it's outside. If you want to put your properties in trust, it's outside. That means also that you don't have that much control over it. The trust controls it. But don't worry. You can be a director in the trust, and you can also make your children beneficiaries in the trust. I think the best way to do that would usually need to speak to a solicitor. There's no two ways around that because it's a bit more complex when it comes to property. You need either a solicitor or a tax planner or basically an estate planner to do that for you. So that's the short answer. You're going to need that because there's quite a bit of paperwork. Having had to do some of that in the past, there's quite a bit of paperwork involved. So that's the best option, I'll say. Secondly, when it comes to working through a limited company or working through private rental, I think it depends on the number of properties you have. If you're a landlord, you've got like one or two buy to let, sometimes the admin burden of running through a limited company might not be worth it for you. You've got to run the numbers. But again, I've run most of my businesses through limited companies even when I was still in like 19, 20. I think limited company is a powerful tax weapon. It gives you a lot of options. So I do prefer to run through a limited company because it allows one big factor. If you run your property now, and this change only came like maybe 5 years ago, I've gotten this section 24 or whatever. If you run your property through your personal account, what's going to happen to you, which I've experienced in the past, is that when you receive your rent is going to be counted as part of your self-assessment. Of course, they're going to allow you to deduct some of it. Maybe they'll allow you to deduct the mortgage payment you're making, okay, the principal, but they'll not allow you to deduct the interest. Then the rest of the rent you receive in bulk is counted as part of your income, which further goes into your self-assessment and helps push you further the tax band, whether it's 45%, 45%, which is really 60%, or whether it pushes you from 20 to 40. So getting that rent in your personal name will do that. On the other hand, if you get the rent in your limited company, limited company, by the time you pay your interest, pay your mortgage, pay your staff, pay accountant, pay different people, and maybe even pay yourself, if there's money left, you still get a dividend. You're not going to have that amount of money left. And meanwhile, the property is still gaining value and accumulating in value, and you're borrowing money to actually, like your mortgage, which is a borrowed money, is still there. Okay, so these are like things to consider, but I'm very biased towards a limited company. But if you just stumbled into a property, maybe you moved house and you rented out your former house, I mean, it's maybe too much hassle to go and be registering a limited company, because then your limited company needs to buy the other house.
It's usually not hard to register a limited company. It's just trying to balance things off with all the cut down on dividends and so on. But that's,
yeah, okay. I don't know if that gives you some insight anyway.
Yes, it does, because it's also balancing like the 60% trap actually in doing, because that adds on to your income. So
In that case, you want to really think about a limited company, because what's your job role?
GP.
So you're a GP. I've got a few GPs here. So a GP, obviously, you're very, either you've already crossed the threshold or you're likely to cross the threshold. So a limited company might actually be better for tax planning. Nothing a good accountant can help with actually, but yeah. And was that the third question? No, your third question was self-assessment in a child saving account. I think it's dreadful, to be honest, that they introduced that. Obviously, I do recommend that it's better to use an ISA, a junior ISA if you can. I'm not a big fan of a junior ISA just because I can't touch the money till my child turns 18, and I don't know if they're going to decide that they want to buy a new Jaguar. You know, some of you have seen the new Jaguar ad. It's all about vibes. There's no car in the ad. There's no car at all in the ad. It's just like, maybe go and watch new Jaguar ad. I'm not going to say more. That's not what this seminar is for. Yeah, but if you already put money in the self-assessment child savings account profit, I'll say that when you are doing your self-assessment, you might as well do it together at the same time. If you're eligible for self-assessment, then that's the opportunity to look at it with your accountant. My suggestion will be to move it as soon as possible to a junior ISA if you have decided to save at all for your child. Other than that, I'll save it in my name and know that my child is in my will.
Okay, thank you.
Well done. Yeah.
So the next is Maduka is asking if to recommend an accountant. So I'm sharing a link.
Thank you.
Moneywise to find a specialist.
Lovely. I'm just going to quickly mention this for one way that you or your partner, as they said, may pay a tax charge known as high income child benefit. If you get child benefit, and either of you has an income over 50,000. So these are part of the things to also remember when you are considering, obviously, your overall tax planning. I'm sure you already know this. Okay, let me just say a quick few things before the other questions. 2025, whether you're in the mastermind or you're not in the mastermind, there are some things you really need to tighten up, because obviously the new government is looking for money and they're talking about is that 20 billion tax hole or whatever, and so they're looking for money everywhere, and they've done these budgets trying to cut money from everywhere, and GP partners whom I feel a lot of sympathy for are suddenly being hit with this employer NI and several other small businesses, farmers, even your NHS pension is going to fall into things that can be taxed for inheritance. Chigo, you brought up that really insightful story in the private group about someone who died and then left money for the family, and the family got hit with this massive inheritance tax, and unfortunately, they're now facing inheritance tax. Inheritance tax is 40%. There's a reason we'll talk about it. That means that if you left the house worth £1 million for your family, and after all the tax and whatever, I think you're allowed maybe 500k at some point. I can't remember the exact figures. They get to pay 40% of the value of your estate, which will include your house, money you have in your bank, different things. A lawyer will help you with that. Now, 40% of that is inheritance tax. If your family can't come up with that money, they might need to sell the property quickly while they are moneying you and everything to pay it. Different discussion. But now, going into 2025, you need to be more tax conscious. If you've not claimed your tax relief, go back and claim it. You can claim back 4 years and the current tax year. This current tax year ends April 5. So claim as much as you can. There's already videos there. If you take 30 minutes or 1 hour and do it, that might be your most profitable hour in the year. Because if you can, I know a GP that claimed about £9,600. Obviously, he wasn't giving £9,600 in cash, but he got 40% of that in tax relief because he was a higher rate taxpayer. I know several other people that claim about the same amount or less, but the maximum you can claim in a year is £2,500. That's if you're not doing self-assessment. So do your tax relief, maximize your ISAs. I'm surprised that the new government did not touch ISAs. Who knows? In the next budget, they might touch it. Yeah. So take full advantage of your ISAs. If you don't have £20,000 to put in your ISA, that's fine. But put what you have in your ISA. Make sure you're not investing outside the ISA first. It's only when you have a good problem, when you've exceeded the 20,000 ISA allowance, then you start looking at other options. 3, I think it's really important to look at things like income protection, life insurance, and the rest of them, and do them smartly. If you're using a limited company, buy it through a limited company. If not, buy it anyway, but don't overbuy insurance. Make sure you're using an independent specialist advisor who can look at the whole market and get you the best deal. Then the 4th thing I think is really important. Inflation is rising. Inflation is a beast. Inflation is rising. The money you're saving, you think you're saving money. Think about how much £100 could buy last year. It's not what you can buy this year. So people tell me, my wife say, "Oh, I went shopping. I don't really know what's happening." I'm like, I don't really notice the prices. It's not because I have a lot of money. It's because I never ever notice what's happening when I go shopping. I usually want to get out of there. But my wife said, "Oh, you notice that since we are buying at this price, now this price and all that, you can still buy it." Okay, that's great. But many families are being hit hard. Inflation is rising. So if you are just saving your money, like I don't know whether it's 75% or 80% of British ISAs are only in cash ISAs, is all in savings. Absolute mistake, big mistake. Save what you can for your emergency fund, but make sure you start investing. Don't need any complicated investment or anything like that. Learn the basics first. Learn those 7 steps you need to do. If people from my if Chigo or UD can find 7 steps you need to do before you start investing, there's a landing page there. If you share that 7 steps, learn those things and start in your own way, and then continue getting better.
7. There are 7 steps to take before you even start thinking of investing as a doctor or healthcare professional. Now, this is really important to secure your financial foundation before you start investing. Now, I've covered these 7 steps in a simple guide that I've made available for you in the link in the description. You can download it. It will help you to build a solid financial foundation, avoid common investing mistakes, and also make tax-efficient investment decisions. Start your investment journey the smart way. Download the guide now using the link in the description, and good luck on your investing journey. Now let's get right back to the episode.
2025 to really get prepared and be more mindful of your finances. Try to figure out, okay, is there anything I can do to make things better here? Is there any area I can improve? And is there anywhere I'm bleeding money? Is really very important. Okay, all right. Now that I've said that bit, maybe we can answer a couple more questions. It's 10 o'clock now. Okay, let's do the last one then.
Chi, our favorite Chi.
Oh yeah, someone asked, is it Chi? Like Chi from
I think she's the one.
Okay, let's hear her voice and know. You've got a Chi, two Chis now. Oh yeah, it's you.
Chico is the main Chio.
No, both of you. These are from our premium group, private group. Right. How may we help?
I mean, I suspect I know the answer to this already, but it's just something you said in the last few minutes that just made me think, oh, wait, hold on. So we've always talked about emergency funds.
Yes.
Having some spare cash that would take you through maybe 3 to 6 months, depends on how much you could save. And then you said something about, oh, some people are just having their money sitting in a cash ISA. To better with an investment ISA. Now, for people that don't have, because there are quite a few of us around that don't quite have enough money to have completed our emergency fund and then have the rest to invest, would you say your emergency fund would make sense to save it in an investment ISA? I'm thinking that if it is an investment ISA, if you need the money suddenly, you wouldn't just be able to get it, isn't it? An investment ISA is like #long term. Like
yes.
money you don't need to use.
#long term. I like that.
Yeah.
All right.
Okay.
Well, thank you, Chi. First of all, I want I just acknowledge Chigo and Chi. Obviously, they were in the master class for 4 weeks. I think the first day was probably brutal, 5.5 hours, and suddenly they turned to investors overnight. But they're really good. They're in the premium group. They could have asked me this question in the premium group, but they always show up. And they're always very supportive. And that's why they've actually moved so quickly in their financial journey. To answer your question, yes, I don't think you should take money from your emergency fund anywhere near an investment account. Don't, if possible, put them in a different account. If you can put them in a different bank, better. So until you complete your emergency fund, I am not a big fan of investing. So I don't know if anyone managed to find those 7 things. You should do. There's a proper landing page. If you share it, people can go download it.
I've shared it.
Thank you. Oh, that's brilliant. So one of those 7 things to do before you start to invest is having your complete emergency fund, because you don't want to have palpitations, right? Sometimes the market goes down and goes up. In over 20 years of investing, most time people hear the other part of the story. They hear, oh, you made 78% returns. What they don't hear is that sometimes your stock portfolio was down 50-60%. And you knew that, okay, on the other end, okay, this company is going to do well. Not that you're 100% sure, but you've done your numbers, done your analysis, fine. But if you don't have that emergency fund, you might panic and may want to sell. But yeah, if you have the emergency fund and your tire gets busted, your boiler decides to mess up, especially during winter, then you can just use the emergency fund. Yeah. So no emergency fund money in investment account. Once you've saved up that 3 to 6 months, I'll say 3 months. If you've got a regular salary job, you've got NHS pension, maybe 3 months. But if you're like me, you haven't got a regular salary job, you haven't got like a rich uncle, and you haven't got like NHS pension, then maybe make it 6 months. So if you can do better, that would be great. So once you have that, then the rest of it, you can always go and invest. Of course, you can also have saving pots, like saving for a holiday, saving for a dream trip. Again, those type of money might not actually be good for investing, because when you invest money, like Chi said, is #long term. Right. Chi, I hope that answered the question.
Yes, thank you. It's what I thought. I just want to
confirm.
Yeah.
Absolutely. It's always better.
But we're all at different stages, and sometimes you'd be like, you want to stop second guessing yourself. Also, you need to reaffirm the choices you're making with all the knowledge you have around you. I mean, to be stupid not to clarify issues when we have this opportunity. And someone just asked if they can save their emergency fund in a cash ISA.
You
And
can
the
answer
answer
that
is
one.
yes.
Yeah.
The answer is yes, you can.
You can. That's great. So I like what you said about making use of your peers, the knowledge you have, and that's basically being in a group where people can support you. That's part of what we offer in the premium group, the mastermind, and all of that. If you're in a community where people don't think it's a bad thing to want to get ahead financially, and you have people can encourage you to say, oh, all right, let's get out of debt together. Let's start investing together. Like have one-on-one where you meet like really senior doctors and they're struggling. And it shouldn't be. You've got like I think I had a one-on-one with a gentleman, excellent doctor, very senior in his profession, very good at what he does, now in quite a bit of debt because of black tax and everything going on. But just by joining a community where he saw other people working towards the goals, that made a massive difference in his morale. And he knew, look, what I'm struggling with, there are people that are ahead, there are people that are behind, but we're all pushing each other, moving in the right direction. Okay. Yeah, so thank you for that, Chi. I really appreciate that. Before we wrap up, I don't know, has anyone got any questions? I know I've shared the landing page for the mastermind, but if anyone has any questions along those lines or anything that is not clear, feel free to ask. Otherwise, if you've got any questions on anything else, I'm quite happy to answer before I get pulled out of here now. I think I'm now entering injury time.
Do you help with your contact email, please, for further inquiries if needed?
Yeah, I'll bump it. It's support at Moneywise Doctor. It should come to the team and somebody would help. But yeah, support at Moneywise Doctor is usually the best way. There you go. Okay, you're welcome.
Nena is asking how to join the premium community.
At the moment, we haven't got any opening for the premium community, and nobody there is asking to leave yet. But there's a mastermind which will open on Black Friday. Everyone who joins through the mastermind would also have access to the premium community. So please, Chigo, if you've got the link to the mastermind, you could post it. So is that either the waiting list or the actual calendar? Because I'm going to post the link now generally to the whole list of I think we've got almost 3,000 or just about above 3,000 doctors now. I'm going to share the full list. So anyone who is interested can also join. Okay. Yeah, that's Paul's question. It says, with regards to capital gains tax, is your capital adjusted for inflation? I'm sorry, they don't care. They don't adjust it for inflation. They just calculate your capital gains tax and charge you like that. Unfortunately not. Okay. Well, thank you again for joining me. It's been we've done it again. I think probably the last one for the year. Just getting a little busy. I've got like 5-month-old who takes a bit of time. Yeah, thank you all for joining, and thank you, Chigo, and every one of you for putting that together. And for those of you who make it to the mastermind, I'll enjoy working with you over the next 1 year. I want us to actually make massive progress. So you can check where you were from December 1. Obviously, the list will go live on Black Friday. You can check where you were from December 1 and check where you are by the time you're coming into 2025, December 1. I expect you to see a massive improvement there, especially a significant jump actually in your journey to financial freedom. And for those of you who don't make it, of course, feel free to make use of our free materials. Okay, Chigo, is that a good time to close? Should we draw the curtains?
Yeah, I think we're good to go. We don't have any other questions from the chats.
All right. Thank you so much, everyone. we're going to make the videos available as soon as possible in line with every other thing going on. And hopefully that should help us to understand anything that wasn't very clear here. Okay.
Thank you.
Thanks, everyone.
Thank you. Bye,
All right.
Chigo.
Cheers. Bye-bye.
Thank you.